Good evening. This is another edition of Resource PNG. On tonight's show, we talk to Professor Magnus Ericsson, co-founder and senior partner of Raw Materials Group, RMG, one of Europe's leading independent group of mineral economists and mineral strategy policy analysts. Magnus Ericsson has been engaged all around the world in his consultancy work. In this interview, we discuss the change in trends of metal prices in PNG. Here's Anya Geno with that interview.
I have with me Professor Magnus Ericsson, the senior partner for the Raw Minerals Group. Welcome to the show, Magnus.
Thanks very much.
Now, Professor, how do you see the changing trends of metal prices affecting PNG?
I think that we will see in the near term it will be a couple of difficult years. 2013, 2014 might also be a tough year, but in the long run and towards the end of this decade, I'm sure that Papua will benefit because we have a focus on copper. I think copper will be doing quite well. Gold might be a bit more difficult on a global level in terms of price level, etc. But on the other hand, deposits in PNG are high quality, so I think in general should be able to make it. Nickel, finally, which is now the third most important metal here, that's much more difficult to say anything about the future. Nickel had a peak in prices over 50,000 a couple of years ago, and then it's gone down. But I think we will see a price level around between 15 and 20,000, which is not too bad after all.
So do you think this is a temporary downturn?
Oh yes, absolutely. There are many factors pointing to that. First of all, that the demand on a global and general level is actually increasing steadily all the time. At the same time, the barriers to entry, that is the problems, the obstacles to overcome to start new mines, are also increasing, which makes it, there will be, as we see it, a slight long-term deficit in supply.
Now, is one of the drivers for this demand China, and how does that affect PNG?
China is, I would say, has been and is and continues to be the number one factor. There is no doubt about that. There are other countries contributing, very populous countries such as India, of course, and Indonesia and other parts of Southeast Asia and other parts of the world as well. But today and during the next couple of years, there is no doubt China will continue to be a major driver. And there is a lot of worries about Chinese demand falling and that the Chinese will not be able to continue their growth at the same pace as they have earlier. And I don't think they will, but I think that the 5, 6, 7% annual GDP growth in China, that is sufficient to generate a very substantial demand for metals. And for many metals also, China itself is a major supplier. China is, if you only look at metals, China is the largest mining country in the world. If you include coal, China alone produces about a third of all metals and coal in the world.
Right.
And when prices are slowly declining as they have been, that means that the high cost producers are actually in China. So Chinese capacity will be unprofitable, which means that they will have to import more ores, more metals into the future. And on balance, I think this is very good for PNG. The country is well located to export to China. And with, for example, the Ramu nickel project, also Chinese investments are coming into PNG. I think it's an ideal situation.
Do you think China will continue to be the strongest player in that market?
Oh yes, I'm convinced they will. No doubt their growth rate will be declining. I mean, they grow 13, 10, 12, 13% a couple of years ago, and that might decline now to perhaps 6, 7, as I said. But on the other hand, those 6, 7% annual increase into the future is from a much higher starting point than the 13 was 5, 6 years ago. And in absolute terms, the demand for metals, or the increase in demand for most metals in China, will be the same as it was 10 years ago. So there is, with these increasing problems to start new mines, it's to get all that new capacity into production will be difficult, and that's why I think the price levels will remain on a fairly reasonable level.
More of this interview after the break. Welcome back. We continue the interview with Professor Magnus Ericsson, Senior Partner of Raw Materials Group.
Now, prior to the downturn, there were a number of projects here in PNG that were stalled, such as the Andera, many of those. What is your outlook or your opinion about the prospects for these projects?
First of all, those projects are, in terms of their the grades and the quality of the deposits, there is no doubt they are world-class deposits. What is difficult in Papua New Guinea is, of course, the infrastructure, the lack of trained people, etc., and the high cost of bringing these deposits into operation. And I'd like to say that I think gradually the situation improves. Infrastructure is gradually being developed. There is more and more people who have been engaged in mining in PNG that has the capacity to come on to the new project. So from those points of view, the situation will improve over the next 5, 6 years. On the other hand, there will also be competition for capital investments, and the attractiveness on Papua New Guinea depends to a large extent also what is government going to do in the future. How will they push through with their new proposed increased government ownership, etc. So there are many factors here, and in the short term I think it will continue to be difficult to find investors, not only in Papua New Guinea but over the rest of the world. But I think in a couple of years there is a high chance that we will see another spike in commodity prices, and then investments will flow back in. If that doesn't happen, investment will start flowing back in a couple of years anyhow, because of the gradual increase in demand globally.
What other factors do you think can affect exploration activity in PNG and turn it around?
Well, metal prices are very important, and when people see that metal prices won't go downwards, they will stay on a very high level historically and gradually increase. That will be one very important factor. A second factor is really that that government maintains stability in mineral legislation, and if changes are going to be made, that they are made in consultation with industry, because there is a tough competition now for investments from countries all over the world, and it's not a static situation. So if tax regime, legal requirements in Papua New Guinea are changed too dramatically, investments will go elsewhere, in spite of the geologically very interesting country which PNG is.
More after the break. You're with Resource PNG. In this part of our interview with Professor Magnus Ericsson of Raw Materials Group, we get a comparison of PNG's minerals to the rest of the world.
In your opinion or your experience, the minerals that have been mined in this country, are they comparable to the best in the world?
Absolutely, I think definitely can say so. And I mean, Papua New Guinea is a new country compared to a historically great mining nation, and it still has to build its reputation. And in my experience, and I've been working with the MRA over many years with this, there are many misconceptions around the world about Papua New Guinea and the great geology and the so far stability in its mining regime is not very well known. So there are still opportunities, I think, to bring in new investors. And as I mentioned already, the Chinese coming into Roma, I think that's very important. When that gets going, it will show to the world that PNG is an excellent opportunity to invest in.
It's a very optimistic outlook.
Yes, it is optimistic, but not for the sake of optimism. It's based on observation of facts all around the world, and so yes, optimistic but realistic.
Now, you're also optimistic about metal prices. Why is that?
Well, as I've said, that we will see a continuous increase in demand, and even if that is slower than it used to be, the problems of bringing new capacity on stream is also increasing. So, on balance, the new deposits will be costly to operate, and prices have to be at such a level that they cover your operation costs. Otherwise, production will not start, and that won't work, because then demand won't be met. So the higher operating costs will put a floor under prices. And when you look at those components, there is no chance that very or increasingly lower grade deposit cannot be mined if prices aren't at a reasonable level. So that's the basis of our. And we have analyzed in detail all the new projects all over the world and come to this conclusion.
So Magnus, what are the key determinants of mining capital expenditure?
Well, it is basically how much ore do you have to mine and process and transport. So that is dependent on the grades of the deposits. And in general, grades are going down. But in the next couple of years, we will see how that downward trend will bottom out, because prices aren't at the peak level they were a couple of years ago. Secondly, it is also a matter of how much rock, apart from the ore, do you have to take away to get to the ore. That is, how deep do your mines have to be, etc. So that's another factor. And then, of course, how far away from ports and markets are you? How much infrastructure do you have to invest in? I would say those are the key factors, how rich your ore is, where it is located, and to some extent how complex it is also. So those are geological aspects determining that.
Thank you for your time today, Professor Ericsson.
Thank you very much.
Professor Magnus Ericsson, Senior Partner, Raw Materials Group.
World trends in the mineral commodities market coming up next. Thanks for staying with us. In this segment, we take a look at world trends in the mineral commodities markets and how this could possibly be a good thing if it limits exploration activities. The prices of mineral commodities, including fuels and metals, have reportedly undergone periods of boom and bust over the last 150 years. History strongly suggests that the long-run trends in mineral prices are not fixed. Rather, they shift from time to time in response to changes in the pace at which new technology is introduced, in the rate of the world economic growth, and in other underlying determinants of mineral supply and demand. This not only complicates the task of identifying the long-run trends that have prevailed in the past, but cautions against using those trends to predict the future. Because the trends have changed in the past, they presumably can do so as well in the future. A presentation by Professor Magnus Ericsson shows that gold production has been on a decline. China, which is the largest gold producer in the world, together with other gold-producing countries, have been affected by these falling mineral prices, thus causing production to also decline. According to Professor Magnus, there are varying factors that will contribute to the flattening of Chinese production in the next couple of years.
At the same time, on the supply side, we have seen how production in South Africa continues downwards. And I would also think that production in China, which is, as you know, now the largest producer of gold in the world, that will decline when prices have fallen a bit. And also, as I explained earlier, in all metals, that the demand from Chinese government on less energy consumption, more environmental control, more money spent on health and safety, etc. The production costs in China are going to increase as well. So I think we will see a decline, possibly at least a flattening of Chinese production in the next couple of years. So all in all, we see prices being above 1,300 ounces, and that gives at least some hope. And if you push them down to 1,100 next year, I wonder if you can make 500 in next year, but
not next year.
not. So very briefly, John, that's our view on gold, that we won't see anything going below 1,300, at least not on a quarterly or annual average. And as I said, our general view is that prices could really shoot up again because of all the production problems that we see around the world, that the production cost sets a floor for all metal prices. You know, if demand cannot be met at a certain cost, well, then prices will shoot up to make it possible to produce the demanded amounts, whether it's gold or copper or all other metals.
Forward-looking in terms of the price of copper, many analysts believe that the price of copper will remain at a fairly acceptable level for the next couple of years. According to Professor Magnus, this fairly stable price level for iron ore is a reflection of the continuing demand drive, but in the long run, supply and demand has to balance. Furthermore, the difficulty in getting new production going, among others, will contribute to the price of commodities remaining at a reasonable level for some time.
If we try to look a bit into the future, at the far right side here, we have a couple. This is 13, 14 and 15 average prices, and well, these are a number of analysts what they believe, and I think most people agree on that prices will remain, at least for copper, on a fairly acceptable level for the next couple of years as well. In my mind, that is sufficient to be an optimist, at least when it comes to prices. John mentioned that we are doing a lot of work in the raw materials group on iron ore, and a year ago people laughed at us when we said that prices, iron ore prices, well, they might go down to 120 and in the long term a little further, but not go below 100. This year, average prices will not go below 135. And I think it is to a large extent a reflection of the continuing demand drive. And in this slide here, you can see this is not demand, but it is production. And in the long run, production and demand must equate each other. This is total copper production increasing steadily here. And this is the underground part of world production. This is open pit. But it
demand grows slowly but steadily. And at the same time, and this is not the topic of my talk, but at the same time, the barriers to entry, the barriers to supply new capacity increases all the time. And in our view, that difficulty in get new production out and going, those difficulties which increase at least at the same speed as demand. So we will have a situation, we believe, where prices will remain at reasonable levels in the long-term future. This is our forecast, and you can see this orange line. This is our index, which we include here. I think it's 13 commodities, and we weigh them by the value of each commodity. So copper, gold, iron ore is really accounting for most of these. And you can see that we think that we will see a bottoming out next year, 2014, and then a steady growth upwards towards 2020. And I'd like to add that as we see it, the risks of prices falling lower than this predicted level here is much lower than that prices will actually increase above this level. So with the goddess Vanadis, who gave the name to vanadium, my conclusion is that metal prices will remain at fairly good levels. China, there is a lot to say about China, but I'd like just to give you a simple arithmetic example. 10% of 1,000, that's 100. And 5% of 2,000 is also 100. And if I say that 1,000, that was the total world production of iron ore 10 years ago, and it's now 2,000 tons. So every year we still need 100 million tons of new iron ore capacity, the same amount which was very difficult to get going.
More of this report when we return. Welcome back to Resource PNG. We continue our report on world trends in the mineral commodities market. New exploration in the industry will be a crisis, where very little new exploration will be made, and this is in response to the falling prices. However, according to Professor Magnus, the effect of this low level of exploration is more positive as it will result in few projects, thus causing mineral prices to increase.
Exploration. I think that what I'm going to discuss about exploration is really illustrating what I see as an exploration crisis. But when we talk about what effect that low levels of exploration will have into the future, it's more positive in the sense that the industry will not be able to bring an abundance of new projects on board, which will mean that prices will be propped up because there isn't simply enough new projects. This is a graph of global exploration, and as you know, it follows metal prices very well. These are historical figures from the Metal Economics Group in Canada, and we have made some forecasts here based on our price forecast. There is a very close relation between metal prices and exploration levels. And of course, this type of movements up and down is very detrimental to to really finding new deposits. As you saw from the copper graph, where copper production or copper demand grows steadily, this type of pattern in exploration is not very useful. Exploration expenditure should grow steadily if we start, it should grow at the same pace as demand. But then we have to take into account that it is more difficult to find new deposits because they are of a lower grade and they might be deeper down, further away. So their exploration expenditure should rise to compensate for those difficulties. So it's not sufficient to increase by 3–4% every year. It should be something above that. And secondly, when we look back at the exploration successes how successful exploration has been in recent time, the rates of success has gone down. So actually we should add even more funds to exploration to compensate for the fact that it costs more to find a deposit of equal size today than it did a couple of years, or say a decade or 2 decades ago. And we've been trying to look at this. Is there a high inflation, for example, in exploration, higher than in the rest of the society? And we can't find any strong indicators of that. So that means that it really is more difficult. So if we're going to find more deposits in the future, this type of pattern is really not sufficient. And this will, of course, lead then to a lack of new good deposits in the future, which will keep prices at a higher level. This is, I mentioned that we do a lot of number crunching. We are empiricists, really. This is from the Intera Live database, where we monitor the number of prospects that have been drilled, and you can see how this has been declining since peak in 2011, which is absolutely not sufficient to find new deposits. So there is a serious lack of exploration globally. There is no doubt about that.
Understanding what the future holds for the mineral sector is important to sustain the earnings from the industry. Forward-looking, this is what Professor Magnus has to say on the future of the mineral sector.
Mining capex, and Mr. Chairman here mentioned that we do a lot of work for equipment suppliers, and for them, really, future investment levels is a very important indicator, and we've done a fair amount of number crunching here as well, and try to look into the future about what capex is necessary to produce the metals that are demanded. And this is quite a difficult task, I must say, because there are many things that can vary into the future. The physical volumes of ores and waste ore handled, that's really the basis of the capex. If you have to mine 2 million tons instead of 1 million tons, that will increase your cost and increase your investment demands. But into the future, and we have seen in recent years, I should start at that end, how grades of the ores mined have gone down. And most analysts predict, well, they will continue down, and that will in itself lead to more investments being necessary to treat more higher volumes. I'm not at all sure that this is the case, because when prices are now at a lower level, higher grades will be mined. and we won't see the continued decline in new mine grades or the grades of new mines into the future. We will see a slowdown in that. So that will lead in itself to that in the future lower volumes of ore, or not lower increase in the volumes of ore being mined will be necessary. So that's one factor. Another factor which affects how much ore has to be produced is, of course, what is the recovery grades? Recovery rates, I should say. What is the yield? And perhaps in the future, when ores are getting more complex and we will see a decline in recoveries. This is something we haven't studied in detail, but I just like to mention it to point out the difficulties in really looking into future capex necessary to sustain the industry. Another factor is, of course, how successful will recycling be in the future, because if larger volumes are recycled, there is demand for less virgin ores, etc. Well, what we've done, we've tried to weigh all these factors together and looked very carefully. I think we are the only analysts in the world that actually measures how much ore is produced in every mine and how much waste rock or barren rock is produced in every mine in the world. And based on those ore volumes that we predict for the future, together with his analysis of historical relations between prices and capex volumes, we come up with this graph here. And as you can see, in our world, we only see a very small decline from 2012 to 2013, in spite of all the noise being made of capacities being shut down and developments being postponed. It's most mining companies, even the very largest, do carry out projects to the end. They can't just stop them in the middle. So that's why we see a slight decline 13 over 12, but then a big drop in 2014. So 2014 in our mind is going to become a difficult year. But that's it really. Afterwards we will see a bounce back up again, and you see total volumes here were a bit more than $200 billion invested, go down to a little less than 150 and then slowly back up again. I'd like also to underline that these investment volumes here, they represent companies that we can measure, the major publicly listed companies. But these companies altogether only account for roughly half world production of coal and all metals. The other half is in China, in Russia, and other of the stans, and it's done by private companies which don't report any figures on investment, etc. So there is a big, there are much more to this, to these volumes, investment volumes, than what these pictures show. And I'd like to say that many analysts, they look at the big five and make conclusions from those. That's absolutely nonsense. We monitor here 700 companies, and still we only can account for half the world production of metals and coal, roughly. So there is no doubt that you have to spend a lot of time if you want to understand these things. So our estimate is that if we include also all investments in China and all those places that we really can't measure today, probably at the peak the investment volume was $300 billion annually. And for equipment manufacturers, these opportunities to reach out to the parts of the world which are not fully as capex intensive as the average, how shall I put it, Western mine, that offers a great opportunity for the future. There's no doubt about that. So my conclusions today are really that we are seeing a drop in prices, but it's not going to go down to the levels we were used to earlier. They will remain at a fairly high level. Chinese demand will continue to grow, and also other emerging economies, not as fast as they have done, but still at rates sufficient in our view to keep up demand at increase at fairly good levels. Exploration, no doubt, it's much too low, and this will affect prices even in the midterm as we see it. And finally, the capex volumes are going down next year. It will be a difficult year for suppliers of services and equipment, but it will start bouncing back after that. And as we heard already yesterday, there is no doubt that the super cycle is not at all dead. It's alive and kicking, and we will have a couple of good years, at least to 2020. Thank you very much.
Resource PNG continues after the break. You're watching Resource PNG. We now speak to Tom Charlton, Head of Exploration, Maya Resources, and find out a bit more about the exploration company and its tenements in one of the largest iron sands provinces.
I have with me Tom Charlton, Head of Exploration, Maya Resources. Welcome to the show, Tom.
Hello.
Now, Tom, Maya believes it's got tenements in one of the largest iron sands provinces. Can you describe this region?
Yes, we have exploration licenses that are stretching from Kerema, in fact Tarapo near Malalau, right through to Daru. It's over 400 kilometres of contiguous iron sands tenements stretching along the coastline. Okay,
so when you say one of the largest regions, what are you comparing it to?
I'm comparing it to other known iron sands provinces elsewhere in the world. It's fairly underexplored. I'm actually quite amazed that there's not been much previous exploration for iron sands in the area. We're chasing both iron sands, which iron sands are used for, well, like the name suggests, for producing iron, which is used for steelmaking industry, and also zircon. Zircon is used in ceramics such as floor tiles.
Okay, and what's the potential within these iron sands projects?
I think there's potential for billions of tonnes of iron sands resource in the region. These are early days yet. We're only really commencing our exploration program, but at this stage there was one project in Oricolo Bay, which is near Valhalla River, where there could be potential for over 100 million tonnes of iron sands resource there.
Wow. I understand the company's very much got a PNG focus at the moment.
We are entirely focused on PNG. My background is over 17 years in PNG. I love working in Papua New Guinea. It's my second mother country, and all our projects, we've got copper gold projects, we've got coal projects, and of course the iron sands and zircon projects are all solely in PNG.
Now you're also interested in Lihir style caldera deposits. Yes. Can you speak a little bit more about that?
Yes, we have over 3 copper gold related licenses that are situated on islands that have collapsed volcanic calderas. That's Rambucho Island, that's Garove Islands in Kimbe. Rambucho is the second island of Manus, by the way, and of course Feni Islands, which is 2 islands down the road from Lihir. And all these islands have collapsed calderas. In fact, we have over 7 collapsed calderas on our projects, and surely one of them has a potential mine in the future.
Sure it will. What about your copper gold prospects in Milne Bay?
Yes, we have a project down in Milne Bay called Sadaya and Basilaki Island, the first 2 islands of Milne Bay. And my favourite, it's actually a porphyry copper gold project. It's called Tunawada Project on Basilaki Island. And it's one of those projects that's fallen off the radar in PNG. Not many people actually know much about it. It seems to have just disappeared, but there's fantastic potential there. Preliminary work so far, we've collected samples of 0.85 grams a tonne gold, but the best previous sample is around 229 grams a tonne gold, so there's a high-grade gold potential, but in my opinion, ultimately, we're looking for a large, bulk, low-grade gold and copper resource at Tonawada.
Okay, and how long before you prove up a resource there?
Oh, it could take many years. I mean, some of these porphyry copper projects take many years, but we're young and we're very dynamic and very aggressive in our approach, so we're hoping for within the next 3 to 5 years, hopefully, if everything goes to plan.
If everything goes to
Yes,
plan,
of course.
that's right, that's a key statement. Mayor's also interested in coal deposits here in PNG.
Yes, we're a very diversified resources company, and we're interested in coal deposits and Kalimantan style coal deposits. When I say Kalimantan, Kalimantan is a famous coal mining island in Indonesia, where 15 years ago there was virtually no coal mining whatsoever, and now it's a major export earner for PNG. And we've found coals that are of similar calorific value. When I say calorific value, I mean energy content, because coal is actually used for power generation. So you want to have coals that are reasonable, enough energy to generate electricity. And we have similar coal qualities to what they have in Kalimantan in Indonesia.
So Tom, you've told us about your projects on the ground here. What about your company? Tell us about Maya Resources.
Maya is a privately owned company based out of Brisbane in Australia. However, of course, we're registered here in PNG. We've only been in PNG for 2.5 years, but I've been in and out of PNG for over 17 years.
So lots of experience then.
That's correct, yeah.
Thank you for your time today, Tom.
Thank you very much.
Tom Charlton, Head of Exploration, Maya Resources.
That ends Resource PNG. If you have any comments or queries, do email us on this address, resourcepng@mtv.com.pg. Or to find out more, check MTV online, that's www.mtv.com.pg, and go to our Resource PNG page, or you can check our page on Facebook. Until the same time next week, bye for now.